Hello and welcome to this week's edition of Checks and Balances TV. Today's program is entitled A $2 Billion Blunder. The nation's biggest bank is paying big bucks for its mistake. So let's see how today's news may impact your financial future. JPMorgan Chase recently announced a more than $2 billion investment loss. The collective loss took place over a 6-week period and was the result of the company attempting to hedge its securities portfolio by investing in risky and complicated securities products. Questions are now being raised about whether Wall Street has changed at all since the 2008-2009 financial collapse. And it's giving new ammunition to Washington regulators who want more financial legislative reform. Okay, so what's really going on here? Let's check the facts using our checks and balances process. JPMorgan Chase, the nation's largest investment bank, announced on May 10th that it lost more than $2 billion as a result of risky trading activities. The losses originated out of a London unit of JPMorgan's chief investment office, which is responsible for monitoring the risk the company takes with its own money. The company was trying to hedge its own investments by using complex derivatives and employed a trading strategy that was, quote, flawed, complex, poorly conceived, poorly vetted, and poorly executed, said the company's chairman and CEO, Jamie Dimon. Dimon, often referred to as the King of Wall Street because of his sterling reputation in risk management, has admitted to the egregious, self-inflicted error, saying, "We will admit to it, we will fix it, and move on." He has also taken a very strong position to remind the public that although the loss is large, the bank is in a solid financial position and will still be profitable this quarter. However, as a result of this failed hedging strategy, Fitch Ratings reduced JPMorgan's credit rating by 1 notch and put the giant investment bank on the watch list for further possible downgrades in the future. As you can imagine, the day after the $2 billion loss was announced, the company stock plummeted over 9%. JPMorgan is just now starting to feel the repercussions of this multi-billion-dollar mistake. Chief Investment Officer Ina Drew was a casualty of the $2 billion trading loss, marking the downfall of one of the highest-ranking women on Wall Street. The trader who contributed to the loss, Bruno Ixel, nicknamed the London Whale, is said to be leaving the firm as well, along with a few others. And the Securities and Exchange Commission, the Federal Reserve, and the Commodity Futures Trading Commission will all be examining the New York-based JPMorgan's trading activities and investigating this loss. FBI Director Robert Mueller said the Bureau has also launched a preliminary investigation into the trading loss as well. And 2 separate lawsuits have already been filed by shareholders, both claiming that JPMorgan changed its risk model without telling investors and was in breach of their fiduciary duty. Some shareholders are even calling for clawbacks of compensation by the executives responsible. Yes, this $2 billion loss will likely cost the company billions more once everything is finally settled. Okay, so now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. Many believe that this trading loss has hurt the company's credibility more than anything else, giving it a big black eye at a time when regulators are trying to put an end to risky investment bank trading. U.S. Treasury Secretary Timothy Geithner said JPMorgan's losses strengthens the case for financial reform. And while some parts of the Dodd-Frank bill are still being designed, written, and implemented, many question whether the Volcker Rule, which falls under the Dodd-Frank bill, would have permitted JPMorgan's risky trading activity. The Volcker Rule is meant to prohibit banks from speculating with their own money and risking losses that could prompt the government to bail them out with taxpayer dollars. Unless, of course, the company claims that this risky strategy is for hedging purposes. Sounds like an out to me. And although the Volcker Rule is set to go into effect this summer, critics say this rule has been watered down by bank lobbyists and leaves a lot of room for interpretation. But why is this trading mistake causing such an alarm at this time? Banks have reported losses of $2 billion in a quarter before. Well, it's because this is a sensitive time for the banking industry. Both sides of the political aisle are arguing for legislation reform. One side wants more regulation, greater oversight, and continued reorganization. The other argues for less intervention by the government, as the free market would be the best solution for the banking industry, allowing banks that make poor investment decisions to pay the price by going out of business. However, in today's world of government bailouts, many Americans are concerned that these banks are not only too big to fail, but too big to bail. JPMorgan has more than $2.3 trillion in assets, making it unbailable in the event something goes catastrophically wrong with the company. The government really needs to pick a role. Is it going to allow big banks to fail, or will it continue to keep bailing banks out, even when they make very bad decisions? You know, at some point, the banks need to be held accountable for their own actions. Okay, so what's the bottom line here? My personal opinion is that JPMorgan made a massive mistake, but they are paying the consequences, something all banks should have to do if they make poor investment decisions. With the government being so involved in whether or not a bank survives, there really is little incentive for a bank to be more cautious with their risky investment strategy. I believe it should come down to this. If an investment bank or firm makes a financial blunder and clients lose money, they should be held accountable in a court of law if the company is found to have misled investors. And if the company loses its own money or it's on the brink of collapse, the government should step aside and let it fall. As taxpayers, we should not be the ones who are continually left holding an empty bag. And now for Matt's weekly financial tip, tool, or technique. JPMorgan lost $2 billion in an attempt to hedge against their investments. While the hedging strategy they took was entirely too risky, hedging is typically done to help lessen investment losses if that particular investment declines in value in the future rather than increases as expected. It's really a lot like purchasing insurance. You purchase homeowners insurance to hedge against fire or theft. Now, although it can get complicated, here are 4 simple ways that individual investors can hedge their stock investments in an effort to minimize their risk. Number 1 is with bonds. Stocks and bonds are the 2 most common components in an investment portfolio. And bonds can act as a hedge against market fluctuations and help to stabilize the risk of stocks for investors seeking long-term growth in their portfolios. Number 2 is real assets. Real assets are tangible assets like gold, oil, and real estate. They can offer both hedging and diversification, as they typically have low correlations to traditional stocks and bonds. When added to an investment portfolio, they can potentially reduce overall risk while increasing upside potential. Number 3 is a stop-loss order. Tell your stockbroker or financial advisor what your lowest loss percentage ratio is. In other words, if you couldn't sleep at night with more than a 10% loss on your investments, tell him or her to put a 10% stop-loss order on your account. And then if your investments go below that 10% loss, you move your money to the sidelines while the market continues to decline. And number 4 is avoidance. If you're concerned about losing too much money of yours in the stock market, then chances are you shouldn't have so much money in the market. The best way to hedge your investments against loss is to not be overly invested in the stock market in the first place. Hedging can be a complicated topic and a strategy that shouldn't be done unless you're a sophisticated investor. While in theory hedging makes investments less risky, hedging in too much risk can backfire as well. So be sure to consult with a true financial advisor if you have any concerns about how to properly hedge investments in your own portfolio. Be sure to log on to our website and download our featured report, The Truth About Banks, a free report that gives you the truth about how banks really view you and your money. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Reddick from Checks and Balances TV. Until next time, dump debt, invest wisely, believe in yourself, and make it happen.